Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Caterpillar stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 160 billion market cap. They're trading at $3.29 a share, and they have 489 million shares outstanding. Caterpillar manufactures and sells construction and mining equipment, excavators, telehandlers, mining trucks, wheel loaders, soil compactors, plus many more products and services. Let's peruse their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow more than doubled from under 5 billion to over 10 billion. Really nice growth. And pretty good margins, 15% free cash flow margin. Net income is the profit or loss on the income statement. It's revenue minus expenses. That didn't double, it grew about 90%, from 6.5 billion to 11.2 billion. But their margins are improving a lot, from 13% to 17%. Revenue is a sales for the company, and that peaked in 2023. It is down a little bit in the trailing 12 months, a little under 67 billion. They pay a 1.7% dividend, which cost them $2.8 billion. They have plenty of cash flow to cover the dividend. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 190 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $174 billion. We divide that by 489 million shares. And we get a calculated stock price of $3.55. They're trading at $3.29, so they're trading at a 7% discount. It's a buy according to the model. There are 27 companies in the same industry as CAT, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, second to Deere. They are really leveraged. Not as much as Deere, but they're still pretty leveraged. Debt to equity ratio of 2.1. That means their debt is more than double their equity. They pay a nice dividend, 1.7%. They generate more free cash flow than the other 26 companies combined. They're the largest company in this industry. All their price multiples are worse than the median, but the PE and price to free cash flow are pretty close to the median, and their PE is a lot better than the average. They generate more revenue than Deere and PACCAR, but they generate less revenue as a percent of their market cap because their price of sales is 2.4. Deere is 1.8, PACCAR 1.6. And they're not really growing that much. Their 5-year annual revenue growth rate is 4%, which is equal to the median, but lower than the average. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be really happy at $40,000 today. That's a 15% annual return, a 300% total return. The first 3 years you would have been in the red, so you probably would have sold way before it went up. Not many people hold a stock for 10 years. Actually, I don't think I ever held a stock that long. Back in 2017, I sold out of all my stocks and bought 4 things, and I haven't sold those 4 since 2017. I'm doing the best on Meta, that's up about 280%. I'm up about 130% on Berkshire Hathaway, and I bought Spiders, I think that's up almost 100%, and another ETF, that's up like 70%. Let's take a look at their income statement. The top part of the income statement is the revenue, and that is down. It was 15.9 billion in the first quarter of 2023, now it's 15.8 billion. Most of their revenue is from the sale of machinery, energy, and transportation, 15 billion. They also offer financial products such as loans, 839 million. Let's see if they give more detail on the revenue. Here's a nice breakdown of their revenue. Of the 15.8 billion, 8.6 billion is in North America, 1.6 billion in Latin America. In Europe, Africa, and the Middle East, 2.9 billion and 2.8 billion in APAC. In EAME, revenue went from 3.4 billion to 2.9 billion. That may be from foreign currency translation. It's up in North America from 8 billion to 8.6 billion. Construction industries is their biggest segment, 6.4 billion. Energy and transportation, 5.5 billion. Resource industries, 3 billion. And then the financial segment, a little under 1 billion. Let's go back to the income statement. Below revenue are the expenses, about 10 billion in COGS, cost of goods sold. When they manufacture a truck, the COGS are the cost of materials, cost of supplies, the labor to make the truck, the rent for the factory where the truck's made. Then below that is SG&A, 1.6 billion. So their total expenses are 12 billion. That gives them operating profit of 3.5 billion, which is up a decent amount from last year with lower revenue. So that's a good sign they're becoming more efficient. And their net income is 2.9 billion, up from 2 billion. EPS is 578, up from 376. And they bought back a lot of stock. Last year was 516 million shares outstanding. Now it's 494 million. Let's look at a statement of cash flows. The first section is operating cash flow. That was 2 billion in the first quarter. Last year it was 1.6 billion. The main difference was higher net income. That's why their operating cash flow was higher. They spent a lot more on payroll. This quarter was 1.5 billion. Last year was under 1 billion. This is not their entire payroll. It's accrued payroll. Like if you were given quarterly bonuses, that's accrued until you pay the bonus. So it sits on the balance sheet. So this will be on the liability section of the balance sheet, accrued wages. Here is their balance sheet. And if you go to the liability section, accrued wages, salaries, and benefits, 1.3 billion. Anytime you see the word accrued, these are expenses the company owes but hasn't paid yet. Your credit card is an accrued expense because you're using your credit card, you're buying things, but you don't pay for it until the following month. The company provides loans and leases to customers. They talk about it right here. That's not only for people buying physical products. Some people also get financing for buying power generation. And the average term, the average length people owe is 51 months. Let's go back to the statement of cash flows. So they provided 3.1 billion of loans, and they received 3.3 billion from people paying their loans. They spent 500 million in CapEx for the quarter. Last year was 420 million. In the financing section, you can see the dividends they paid, 648 million. That's just for the first quarter. And they buy back a lot of stock, 10 times more than last year. Last year was $400 million they spent. This year, 4.5 billion. Cash at the beginning of the period is 6.9 billion. At the end of the accounting period, it's 5 billion, 4,965. That number should be on the balance sheet, the cash at the end of the period. It's actually 4,959, but it was 4,965 on the statement of cash flows. That's a $6 million difference. And I think we found the $6 million difference right here. Let's learn more about the company. They are the world's largest manufacturer of construction equipment. That's pretty impressive. They're number one. I didn't realize that. They're one of the 30 companies that make up the Dow Jones Industrial Average. If you trace their roots back to the very beginning, it was in 1890. At the time, they manufactured steam tractors. That's what their predecessor company did, Holt Manufacturing. And these steam tractors were so heavy, sometimes weighing 1,000 pounds or 450 kilos. And they often sank in the earth. That's how heavy they were. The company eventually found a way to make the tractor not sink. They replaced the wheels of the tractor with a set of wooden tracks bolted to chains. The company eventually got a patent for the tractor. That was in 1907. And way back in 1910, they were headquartered in East Peoria, Illinois. But they had a factory in Stockton, California. So they built tractors there and Illinois. And this company sold tractors to the US government during World War I. They shipped 1,200 tractors to England, France, and Russia. The tractors were meant for farm work, but these countries used a tractor during battle. So the company made a name for themselves during World War I with their Holt tractors. It was named after the founder, Benjamin Holt. Since the founder, Benjamin Holt, died in 1920, the new CEO, Thomas Baxter, had a new focus on things. He saw that the federal government funded $1 billion to build highways. So that's what the new CEO did. He focused the company towards building road construction equipment. They have manufacturing facilities all over the world. They've been manufacturing in Brazil since 1960. They recently opened up a plant in Russia. They have a facility in China and in India. They actually have 3 manufacturing plants in India. At those plants, they make machines, engines, and generators. In 2020, they acquired Marble Robot, and this company makes robots for the grocery industry to help them with deliveries. Their main business segment is machinery, and they sell 400 different products. You can find hydraulic excavators, backhoe loaders, off-highway trucks, agricultural tractors, mining equipment, forestry, energy, transportation. In 2011, they began selling a line of on-road trucks. I don't think they had much success with that because they ceased that part of the business. I'm going to quote you what they said. Remaining a viable competitor in this market would require significant additional investment to develop and launch a complete portfolio of trucks, and upon an updated review, we determined there was not a sufficient market opportunity to justify the investment. Part of their business is in the manufacturing of diesel and natural gas engines, and those turbines are used in their locomotives, semi-trucks, marine vessels, also in their power plants and emergency generators. In 1998, they purchased Perkins Engines. They're based in England, a maker of small diesel and gasoline engines. In 2010, they announced they would buy German engine manufacturer MWM from 3i for $810 million. 3i is a British private equity firm. Caterpillar has been criticized because Israel uses some of their products. So people who are anti-Israel have gotten upset at this company, which is just ridiculous. This company just makes a product. They can't control what people do with that product. They entered into a 50-50 joint venture with Trimble. Trimble is a public company, ticker TRMB. That company provides software and hardware for the construction, agriculture, natural resources, utilities, and transportation industries. And this joint venture with Trimble develops positioning and control products for earth-moving and paving machines in the construction and mining industries. And those products are used for horizontal and vertical guidance. Horizontal means maintaining the land, like prepping the soil so when you build a building, it could hold the structure. And vertical guidance is when you go up, when you build a physical structure above the ground, like a house or an apartment building or a skyscraper. And that joint venture started in 2002. CAT also offers financing and insurance services to their customers, both retail and wholesale customers. And they also generate income from licensing products. They license their trademark and logo. So they sell the right for someone to manufacture, market, and sell products using the CAT trademark. Wolverine Worldwide is one example. They're a licensee since 1994, and they make Caterpillar footwear. Wolverine is a public company, ticker WWW. They have nearly $3 billion of annual revenue. They manufacture these sturdy Caterpillar boots. And they have other licensees that sell items like clothing, hats, luggage, watches, knives, gloves, smartphones, etc. They have 110 manufacturing facilities. 51 are located in the US, 59 are overseas, such as Brazil, Canada, Czech Republic, Hungary, Mexico, and they sell their products to end users in pretty much every country in the world. They have a network of 220 dealers. The company Finning, located in Canada, is their largest distributor. Finning is a public company. They trade on the TSX, Toronto Stock Exchange, ticker FTT. And this is a big company, over $6 billion of revenue, 14,000 employees. This company came close to bankruptcy in the early 80s. They were losing $1 million per day due to a sharp downturn in product demand. Also, fierce competition with Japanese rival Komatsu. Komatsu is the world's second largest manufacturer of construction equipment and mining equipment after CAT. And the company really suffered when the US declared an embargo against the Soviet Union after the Soviet Union invaded Afghanistan. That resulted in CAT not being able to sell $400 million worth of pipe-laying machinery they had already built. An embargo is an official ban on a particular country. Like if there's an embargo against Mexico, that means we cannot sell anything to Mexico. or buy anything from Mexico. So in layman's terms, it's a trade restriction with another country. It may not be a full restriction, it could be a partial restriction. For instance, maybe the restriction is you cannot buy products from another country, but you can sell it to them, or vice versa. In 1992, the UAW, United Auto Workers, conducted a 5-month strike against Caterpillar. Then CAT threatened to replace the entire unionized workforce, over 10,000 UAW members. Then in the mid-90s, over 10,000 UAW members struck again for 17 months, a record at the time. In 1994, CAT offered a contract to the UAW members that would raise the top salary workers from $35K to $39K per year. But the UAW was not happy because people at John Deere were making $40,000. Then CAT decided to outsource much of their labor to try to avoid these strikes in the future. Another move CAT did was open up facilities in right-to-work states. Right-to-work states prohibit unions. So they open facilities in North Carolina, South Carolina, Mississippi, Tennessee, Georgia, Texas, and Arkansas. In 2017, the US government raided CAT's headquarters because they thought CAT was engaged in aggressive measures to control taxes. And since 2014, the company's tax policies have been investigated by the US Senate because CAT moves a lot of things offshore to Geneva to mitigate taxes. The IRS found the firm liable for $1 billion of unpaid taxes from 2007 to 2009. In 1999, one of their executives was accused of funneling profits made on replacement parts into Switzerland, even though it had no warehouses or factories there. Finally, in 2023, they reached a settlement with the IRS, and they did not have to pay any penalties. In 2014, the company paid $46 million to settle claims that one of its engines caused a fire explosion. Then in 2016, they paid $60 million to settle claims that its bus engines were prone to breakdowns and fires. So let me know what you think of this type of format. We go through the history of the company and learn a lot more about them. Leave a comment, subscribe. Thanks for watching.